The chip trap. A small island nation, smaller than Switzerland, with no oil, no gas, no rare earth mountains, somehow becomes one of the most strategically important places on the entire planet. Not because of its military, not because of its geography, but because of what it makes. Taiwan produces the most advanced computer chips in the world, and right now, the global economy simply cannot function without them. Your smartphone, your laptop, the AI tools reshaping every industry you can think of, there's a very good chance the brain behind all of it was born in a Taiwanese factory. That's an extraordinary position to be in, and for a while, it looked like a golden ticket. But here's the part that doesn't make the headlines quite as often. When everything rests on one thing, that's not just power, it's also vulnerability. And right now, the cracks are starting to show. Today, we're going to explore how Taiwan's semiconductor dominance, the very thing that made it rich and relevant, may also be quietly hollowing out its economy from the inside, and why the solution to that problem might actually make the original problem worse. If you're new here, please hit subscribe. We break down big economic stories like this one every week. Taiwan's economic story. To understand the problem, you first need to appreciate just how remarkable Taiwan's economic rise actually is. By most measures, Taiwan is already one of the wealthiest societies in Asia. On a per-person productivity basis, it ranks near the very top of the continent, trailing only the city-state of Singapore, which benefits from a very specific set of financial and trade advantages that make direct comparisons a bit unfair. And the recent numbers are genuinely staggering. In 2025 alone, Taiwan's economy grew by 8.7%. To put that in context, that kind of growth is the sort of thing you expect from a fast-developing nation like Vietnam or Bangladesh, countries building from a lower base. Taiwan is already wealthy. An 8.7% expansion at this stage is almost unheard of. The driver? The global AI arms race. Every major technology company on the planet is pouring money into building data centers stuffed with high-performance chips. Google, Microsoft, Meta, together, their projected spending on AI infrastructure is expected to surpass $700 billion in a single year. And the hardware they need? Most of it traces back to Taiwan. This has turned Taiwan's flagship chipmaker, TSMC, into something close to a global utility. The company controls roughly 70% of the world's advanced semiconductor foundry capacity. That's not a dominant market share. It's closer to a monopoly on the future. So on the surface, Taiwan looks like it's thriving. Export records are being broken. Revenues are surging. GDP is sprinting. But beneath those headline numbers, something more complicated is unfolding. Dutch disease explained. To understand what's really happening, we need to take a brief detour to 1960s Netherlands. In 1959, Dutch engineers discovered one of the largest natural gas reserves ever found in Western Europe, sitting beneath the northeastern province of Groningen. For a country still carrying the weight of post-war reconstruction, it felt like a windfall. And in many ways, it was. Gas extraction ramped up quickly. Exports flowed. Foreign money poured in. The Dutch guilder strengthened. The government had more revenue than it knew what to do with, and it invested heavily in infrastructure, public services, and social programs. But there was a problem nobody anticipated. As the currency rose in value, Dutch manufactured goods became more expensive for foreign buyers. Dutch farmers faced new competition from cheaper imports. Workers left traditional industries, chasing better-paying energy sector jobs. Investment in manufacturing dried up. And when global gas prices eventually softened, the Netherlands found itself with a bloated public sector and a hollowed-out industrial base. Unemployment surged. Wage pressures made recovery harder. The two-speed economy, those connected to the boom and everyone else, became the defining social tension of the era. This pattern was so distinctive that economists gave it a name: Dutch disease. The core idea is simple but counterintuitive. A boom in one export sector can actually damage the broader economy by appreciating the currency, draining labor and investment from other industries, and creating dangerous long-term dependence on a single revenue stream. The Dutch eventually found their way out, partly through economic reform, partly through the establishment of a sovereign wealth fund to manage windfall revenues. But the scars lasted for years. Now replace natural gas with semiconductors. Replace the Dutch guilder with the new Taiwan dollar. The story starts to look uncomfortably familiar. Do you believe Taiwan can genuinely diversify its economy, Or is it already too late? Drop your take in the comments below. How it's playing out in Taiwan. Here's how the Taiwan version of this story works in practice. Every time a technology company anywhere in the world orders a batch of advanced chips, they need to pay for them in new Taiwan dollars. As global demand for chips has exploded, so has demand for Taiwan's currency. And as that demand rises, so does the value of the currency itself. For TSMC, this is a manageable inconvenience at worst. The company's revenues and profit margins are large enough to absorb most exchange rate fluctuations. But for a small Taiwanese manufacturer making industrial components, or a family-run textiles business trying to compete in export markets, a currency that suddenly appreciates by double digits in a single year is potentially fatal. Their products get more expensive overnight. They lose contracts. Workers get laid off. The labor market tells a similarly divided story. Taiwan's semiconductor industry pays extraordinarily well. The average annual salary at TSMC is approximately $116,000 US, a remarkable figure in a country where the typical cost of living for a single adult is closer to $9,500 a year. Engineers in the chip sector are, by local standards, exceptionally wealthy. But the semiconductor industry only employs a fraction of Taiwan's workforce. The median salary across the broader economy sits around $17,000 US annually. And here's the compounding problem. The spending habits of a relatively small group of highly paid tech workers are inflating prices for everyone. Housing costs are climbing. Consumer goods are getting more expensive. Rents in major cities are increasingly out of reach for those on median incomes. In other words, the semiconductor boom is generating wealth, but it's concentrating that wealth in a narrow slice of the population while making everyday life more expensive for the majority. That is the two-speed economy in action. And it extends beyond just wages and housing. Taiwan's non-semiconductor manufacturing sector has been quietly shrinking as a share of the economy for years. Investment flows toward the high-margin chip business. Talent gravitates there too. And the industries that once gave Taiwan a diversified economic foundation are struggling to keep up. The country is, to use an economic metaphor, leaning its entire weight on one leg of a three-legged stool. The compounding risks. The domestic economic imbalance would be concerning enough on its own. But Taiwan's situation is made significantly more precarious by a cluster of risks that all converge on the same pressure point. First, the cyclical nature of the chip industry itself. Semiconductors have historically moved in pronounced boom and bust cycles. Periods of frantic demand are followed by sharp corrections as supply catches up and investment slows. Many analysts argue that the AI-driven demand surge is different in kind, more sustained, more structural. And they may be right. But history is littered with industries that were once declared permanently immune to cycles, and weren't. If the AI investment wave reaches a point of diminishing returns, if enterprise spending cools, or if the bubble, if that's what it is, deflates, Taiwan would feel it immediately and severely. Second, the geography. Taiwan sits on some of the most geologically active land on Earth, at the intersection of tectonic plates and in the direct path of Pacific typhoon seasons. The entire island is classified as high risk for both earthquakes and severe tropical storms. In 2024, a major earthquake, the most powerful to strike the island in a quarter century, temporarily halted operations at TSMC facilities. The disruption was brief, but it served as a sharp reminder that the world's most important manufacturing infrastructure sits on genuinely unstable ground. Third, and most discussed, geopolitics. The People's Republic of China has never formally acknowledged Taiwan as an independent nation and maintains that reunification, by peaceful or other means, is inevitable. This isn't just a theoretical risk. It shapes investor behavior, government borrowing costs, and foreign business decisions every single day. Companies looking to invest in low-cost Asian manufacturing generally look elsewhere, to Vietnam, Malaysia, or India, partly because labor costs in Taiwan are higher than its regional peers, and partly because no multinational wants to expose its supply chain to potential military conflict. That geopolitical discount has real economic consequences, and borrowing costs are sensitive to every flare-up. In 2022, a single high-profile visit by a senior American political figure caused yields on Taiwanese government debt to nearly double in a matter of weeks. The cost of borrowing has remained elevated and twitchy to geopolitical headlines ever since. Can it be fixed? Taiwan isn't sitting still. There are genuine efforts underway to address these structural vulnerabilities, though each solution comes with its own complications. Currency management is one tool. Taiwan holds one of the world's largest foreign currency reserves, over $600 billion as of 2026. This gives its central bank significant ability to intervene in currency markets and soften the appreciation pressure on the Taiwan dollar, helping non-tech exporters stay competitive. The problem: the United States has taken notice. Taiwan has been placed on the U.S. Treasury's watch list for potential currency manipulation. That's an uncomfortable position to be in, especially during ongoing trade negotiations. Walking the line between managing a currency for stability and managing it for competitive advantage is a fine distinction, and one the Americans are watching closely. Economic diversification is another avenue. The Taiwanese government has launched programs designed to build up non-semiconductor manufacturing and agricultural sectors, with the goal of raising wages and opportunities for workers outside the tech industry. These efforts are real, but the semiconductor sector is accelerating faster than diversification can keep pace with. You can't easily plant new trees when the existing forest is growing taller every year. Strategic offshoring may be the most interesting move on the table. Taiwan recently finalized a trade framework with the United States under which it will invest $250 billion in building chip manufacturing facilities on American soil. In return, U.S. tariffs on Taiwanese goods will be significantly reduced, and critically, semiconductors themselves will be largely exempt. For Taiwan, this achieves several things at once. The massive capital outflow helps reduce upward pressure on the currency. It deepens Taiwan's integration with the American economy and security umbrella, and it diversifies TSMC's geographic footprint, reducing its concentration of risk on the island. But here too, there's a paradox. Taiwan's semiconductor dominance has long served as a kind of strategic deterrent, sometimes called the silicon shield. The logic is that no rational actor would attack or blockade Taiwan, while doing so would also destroy the chips that the entire global economy depends on. If Taiwan moves too much of its advanced manufacturing offshore, it weakens that shield. The very act of solving its economic vulnerability could reduce its geopolitical protection. What it means for real people. Zoom in from the macro level, and you reach real people. The average Taiwanese citizen lives in one of the richest economies in the world by official statistics, a GDP per capita of around $41,600 US. But for most working people, that figure doesn't map onto daily life. When a large share of national output is concentrated in a capital-intensive industry that employs a relatively small workforce, GDP per capita becomes a misleading measure of lived experience. Housing is increasingly unaffordable. Wages in non-tech industries have grown slowly. The cost of goods and services has been pushed up by the spending power of a semiconductor-rich minority. And the career ceiling for someone who didn't land a role in the chip ecosystem can feel frustratingly low for a country this wealthy. There is a real and growing gap between what Taiwan has achieved as an economy and what that achievement feels like to ordinary Taiwanese people. Bridging that gap, without sacrificing the industry that created the wealth in the first place, is the defining domestic policy challenge of this moment. Closing thoughts. Taiwan's story is, in many ways, a story about the strange costs of success. Building a near monopoly on the world's most critical technology is an extraordinary achievement. It has made Taiwan wealthy, relevant, and in some ways protected. But it has also created a set of economic distortions that are genuinely difficult to untangle. A modern, high-tech rerun of the same trap that caught the Netherlands 60 years ago. The challenge isn't that Taiwan is doing something wrong. It's that the very things it's doing right are creating new problems that require solutions, and those solutions create problems of their own. What happens next depends on a lot of variables that Taiwan doesn't fully control. The pace of the AI boom, the decisions of American tech giants, the behavior of tectonic plates, and the calculus of leaders in Beijing. What Taiwan can control is how it manages its wealth, how it diversifies its opportunities, and how it ensures that the miracle it has built actually improves life for the people living inside it, not just the ones lucky enough to wear a TSMC badge. Because a country that produces the brain of the modern world probably deserves to feel as wealthy as it actually is. Thanks for watching. Why China is so fixated on Taiwan in the first place. Please subscribe the channel if you want to understand the other side of this equation.